2021 was not a good year for gold as it lost about 4%, the first negative yearly returns in the last 6 years. This follows strong gains of 28 and 24% in 2020 and 2019 respectively. Last year, we expected gold to remain sluggish in the early part of the year but to end on a positive note. Based on a technical study, we expected gold futures on the multi-commodity exchange to touch 56,000 Indian rupees. However, the yellow metal ended the year lower, although it was stuck in a broad range of $1,680 to $1,920 for most part of the year. Investment demand, aided by the unprecedented liquidity provided by central banks, powered the rally in the preceding 2 years. However, in 2021, several factors played out against the precious metal. 1. There was a significant drop in investment demand because of outflows in ETFs. Investment demand in the first 3 quarters of 2021 dropped by 38% to 700 tons, according to latest World Gold Council data. 2. The dollar picked up strength since June and thus, the dollar index appreciated by nearly 7% in 2021. 3. As economies opened up, investors started playing risk-on game and this is not particularly the favorite turf for gold. Finally, the U.S. Federal Reserve, towards the end of the year, announced the timeline to end its asset purchasing program and the latest dot plot indicated 3 possible interest rate hikes in 2022. However, despite so many negative factors, gold avoided a deep fall in price. Jewellery demand, which went up by 48% to 1,323 tons last year, can partly explain this. Now it is almost certain that the Fed is likely to start raising rates in 2022, although the pace may vary from the expectation. In that sense, Treasury bills, which come with safety as well as an interest payment, might appeal more to investors, which can result in some asset reallocation from gold to U.S. Treasury. In addition, increase in U.S. interest rates can further strengthen the dollar. This will certainly have a negative impact on gold prices. On the other hand, rising inflation across all regions can boost gold as it is seen as a natural hedge against rising inflation. Also, economic recovery means more disposable income with people, which can translate into better consumer demand. Particularly, jewellery demand, which is already on a rise, can push demand up for the yellow metal. That said, the Omicron variant of coronavirus, though deemed to be less fatal, is proving to be more contagious and is spreading fast across regions, particularly Europe. The weekly COVID report by the World Health Organization shows that in the week ended December 26, the number of new COVID-19 cases in Europe increased by 39%. New daily cases in some countries have already surged to record levels, straining the healthcare system. Global fresh cases, too, are up by 11% in the corresponding week. Governments have started imposing restrictions, and this is creating fresh uncertainties on the economic growth front. To summarize, central banks closing the liquidity tap and possible rise in interest rates can have negative effect on gold prices. However, hardening inflation, bettering jewellery demand, and continuing ambiguity around coronavirus and resultant uncertainty in monetary policy can support the yellow metal. The slowdown in Chinese economy is also seen as a cause of worry for the global economy. Overall, the positive factors for gold might outweigh the negative factors, and, therefore, prices can be expected to appreciate in 2022. Also read, Fixed Income Outlook for 2022. Gold began rallying from about $1,200 in October 2018, which eventually led to the breakout of the critical resistance area of $1,360 to $1,400. Following this, the yellow metal picked up more momentum, establishing a strong uptrend. This continued until gold hit a fresh all-time high of $2,075 in early August 2020. Thereafter, the price began to soften and in 2021, it largely held in the broad range of $1,680 to $1,920. Ideally, until gold moves out of this range, the next leg of trend will remain uncertain. However, the support band of $1,680 to $1,700 is holding strong and the likelihood of these levels getting breached is low. Even if price slips below $1,680, the 50% Fibonacci retracement level of the prior rally at around $1,620 can be expected to arrest the decline. In our view, gold will most likely touch $1,920 in 2022. A breach of this level can induce more upward momentum. The overall trend is bullish and there are significant support levels. Although gold might experience some weakness in the first few months of 2022, it can be expected to produce positive returns this year with potential targets at $1,920 and $2,075. Gold futures on the multi-commodity exchange is forecast to reach 52,300 Indian rupee. If the momentum sustains, it can retest 56,000 Indian rupees levels during the year. Also read, Equity Outlook for 2022. Irrespective of the market conditions, one can always maintain 10 to 15% of gold in overall portfolio as it is an effective diversifier. If you would like to own gold, sovereign gold bonds issued by the RBI and gold exchange traded funds offered by mutual fund houses are the preferred option. For those who don't have a demat account, gold funds are available too.